Now, the property we're buying right now. Oh, and I've got to do something on this. How do I do this? Hey, all right. Reasons why we like this deal. First off, it's Denton. It is a student property. It's adjacent to TWU. Okay. Anybody know Denton? Okay. Adjacent to TWU on the east side. Most of the tenants, though, it's student housing, most of them go to UNT. Our original plan was to convert this to market rate. However, while we were going back and forth and it was under contract, they went ahead and renewed all the leases, which all expire in August, to go ahead and renew in September. Is that right, September?
That is one, yes.
So they went through and renewed all the leases, and we're like, we can't raise rents. We can't do anything about that. So we started looking at the numbers going, well, we'll just keep it as student housing. And their expenses are about $11,000 a door.
$11,239 to be
11
exact.
So the expenses on this property are extremely high. They shouldn't be, especially when you only do leasing pretty much one time a year. And they're already, also built in 2016. We're only paying $135,000 a door. In Denton, adjacent to a college, 2016, beautiful property, $135,000 a door. So it's a great price per pound deal, plus it's got good income. It's a management value add because of the high expenses. Of course, consistently high occupancy being student housing. And they're already pre-leasing for 2024 higher than the rents that I projected. The rents that I projected in there were the same rents they're getting right now, but then we were budgeting in a couple of percent increase. So we were only saying, well, we're only going to have 3 months or so of rental increases by the time September kicks around, yada, yada. Doesn't really matter. But bottom line is they're already pre-leasing for higher than we thought. We're getting Fannie Mae fixed debt. It's a 506B, so our unaccredited investors can participate. And we only have room for 34 of those. So if you're unaccredited and you want to get in, make sure to go ahead and do that. You see who I'm looking at. You've asked a few times. And we're already 48% subscribed verbally. And because, is it up on the website?
It went live today.
You went live today on Keep. So
IMS.
on IMS, you can log into IMS or you go to darwingerman.com and log on through there. And so again, a great deal. And the reasons why we like that is all of those reasons.
Let me also expand on why it's a value management value add. So this is a company that is exclusively student housing centric. However, this is their only asset in DFW. They have, I think, 3 assets in the Austin area, College Station as well, and everything else is outside of Texas. And this has been their redheaded stepchild, if you want to put it that way. And it has not been a good experience for them. Not to mention that they have a management company. If you know Zeus, if you know, if you knew about this management company, they are notoriously horrible. And so therefore, they just want out. They want out. And so we were able to lock it in. Fortunately for us, we have a reputation of being closers, and we work closely with this particular brokerage group. And so when they came to me with the deal, that had offered it to a couple of other people. The one group that actually had an LOI on it backed out because they didn't feel they could pull the deal off. And so we slipped in, and we've been going back and forth for as very many months as it has been. But this is going to be a home run, guys. It's going to be a great deal.
Great deal to kick off 2024. Yes, sir.
So what's the rent increase on this pre-leases?
The rent increase on the pre-lease, I don't know how much it's
On the pre-lease right now, it's $24 over what our projected was. So
What percentage?
I'd have.
That's all in the
yeah,
PPM. So
yeah.
So the performer that came out today, it's a new one. It's updated.
Correct. Everything that's loaded up on IMS now is all current numbers, not the numbers that we had originally talked about.
we originally did because we've been
were
working
going
on this
assumption,
5 months.
and we were going assumption originally.
Originally, it was an assumption, and originally we were going to switch to a market deal, but the numbers that came out today are our current projections.
And pre-leasing here means the new rents are starting from August.
Not necessarily, because as students, they move in and out, and we rent by the bedroom. So somebody coming in new will pay a higher rent right now, just if there's like transfers.
And also the pre-leasing.
Most of them rotate in August.
Most of them rotate in August.
Generally, about 50% are moving out.
In August.
Yeah.
And in between there, it's minimal. Yes, sir.
But right now they're at 99%, 98, 99% occupied, and they stay full.
What's the average as well? What's the long structure? Because agencies, they have like specific regulations when it comes to student housing.
We are still narrowing down exactly. We've
what
already
is
got
the
a soft quote.
What's the question?
The question is the debt,
Okay.
because Fannie Mae is particular about student housing.
Well,
and-
Fannie is particular about, but that doesn't mean they're not willing to do it. So yeah, we're going through Walker Dunlop for our Fannie debt, and they're fully engaged. So it's all that's missing is the hard quote.
We've got our soft quote, and they've already been working on the hard quote.
Yeah. And here's a peculiar little thing, Paula. When you're at 98, 99% occupied, what do you do? Raise the rents, right? I know, but unfortunately, the makeup of this tenant base, and I don't know how they got here, but it doesn't matter. All the leases come due or expire in August and renew for September. So as much as if it was market housing, we'd be raising rents right now at 98, 99% occupied, but we're locked into these leases, and there's not anything we can do about them.
Okay.
Can you give like a 60-second overview of how any other issues like student versus normal?
The differences between student and normal. The big thing is we plugged in here, we've got 90 units, but 132 leases.
132 beds.
Because there's individual leases per bedroom. So you've got leases per bedroom, and so you've got common area. We are then also paying for, internet, electricity. So expenses are going to be higher anyway. We're only budgeting, they're at 11,000 and change a door. We're budgeting 10,000 and change a door. That's because they also have on 90 units a staff of 4 people, and they only do leasing one time a year. I'm like, this is completely overstaffed. Don't need that amount of people. It is a little bit more management intensive, just because you have, roommates. They may not get along. They got to transfer over to a different one. So some little personality issues.
And also
like
one additional thing, as of September of this year, 100% of the units will be, the tenant pays the electricity. So the house pays it, but it gets billed back.
They were not billing back before. And just like on Saginaw, I think that was Saginaw where we bumped up other income. Same scenario here. We'll be bumping up other income along with the rental increases. And that, not too much of that is plugged in.
I'm sorry, did you talk it, what you're gonna be able to do on the debt?
What we're going to do on the debt, do you remember that off the top of
Yeah,
your head?
so right now, the debt has been soft quoted, and we're waiting on a hard quote for both the dollars and the actual interest rate. The interest rate would be a little harder to peg because, as you know, it's tied to the Treasury notes, and they've been fluctuating, but the trend is down. So by the time we're ready to lock in, we could potentially be looking at about 5.5 to 5.75%. On a well, we're not sure yet whether we're going to go with a 5 or a 7 year, but we'll go with one of those two, and it'll be amortized over 30 years.
Is there a
Fixed.
How much average? Like how much?
Leverage will be somewhere in the range of about 65%.
Julian, is there prepaid payments?
Well, yeah, it'll have. Yes, it more than likely will go with the yield
Here's the
maintenance.
thing on the loan.
Yeah.
Is we go through and we run all of our numbers, run all our traps, do our due diligence, give it over to the lender, and then they get different quotes. Fannie Mae has underwritten this on numerous different ways. So we've got numerous different quotes. We've got 5-year, 7-year, 10-year. We've got it based on different loan to
Step
values,
down.
with step down prepayment, with defeasance, with rate buy down. And bottom line right now is let's get it all 100% approved. And even though we've got a budgeted number in there, we'll adjust that based on where it all comes back in at the time of being able to launch.
So they'll give us basically a menu. This is what we'll do
And
on a 5
Nikolai knows all that. I'm talking to
Yeah.
him, but talking to everybody. Okay. And but the thing everybody always wants to know. Oh, Trace, did you have
12,150,000.
12,150,000. 5.8.
But that's everything. That includes closing costs, reserves, CapEx, everything.
Okay. And then the question is, because we always do, all those returns I gave you earlier, those were the partner level returns, not property level returns. Remember when I was talking about that earlier and I was talking about the returns to the partners and all these? That's partner level, not property level. It's real important for you to understand that because you get diluted by a syndicator because they have to be compensated also. But so many times people quote what the property is going to do, not what makes it down to you. So that's one of the things I think we do a little bit different. We said, okay, what can you expect for a $100,000 investment? What can you expect? And this is ours, sandbag numbers. We're budgeting in there. You invest $100,000, you get $2,800 year one, 2.9%, $3,500, 3.5%, $4,200, et cetera. And then upon the sale, $165,000, $159,000 from the proceeds, $5,600 from the sale. That total comes to $180,000, which is a 1.8 multiple, or 80% divided by the 5 years, gives you 16.1% average annual return. So we're looking at a 16% return to
If we can't do better on the expenses.
Yeah, if we can.
I mean,
We're pretty
come on.
conservative on our numbers, and so we've exceeded 90% of the time. We've exceeded our projections, so we hope to exceed them on this as well. So 16.1% on that one. Any questions on this particular slide? Because this is the one that it's my belief that we tell you what this is, but then open book on everything else on how we calculate that. So we do a video that goes through all of the numbers to say how we came up with that number. Because anybody can say, oh, it's going to be a 2x return, or it's going to be this return. Well, how did you get to your numbers? Prove it to me. I want to see that you didn't plug in a 3% exit cap rate, or 20% per year rental increases, or left off taxes on your expenses. Which, honest to God, I've seen that. And so that way you can go through that. And so we do a whole video on it. We've got one video on there now. How do we access that video?
Well, it's going to be, we'll be putting out a full marketing package on the property, which will have video, the investor presentation spreadsheet, and a full narrative on the property. So we'll have that out probably by Friday.
Okay, because we've already recorded I actually recorded it in Florida in a hotel lobby as far as the investment presentation. So there might be some background noise in there. It might be a little fun because that's a new one for me. But we go through every single number, how we came up with it, what it is. I don't know if I did it on this time. Sometimes I, test it. What if it's this? What if it's this? What if it's this? I'm not sure if I did it on
You
this
did.
one.
You stressed us.
Stress test a little bit so you can see what it is. We also put in there, if I really screwed up on my numbers or if we exceed them, what those returns would be, just so that you can see everything on there. So there will be a video that looks like this that's investment presentation, and that goes through the numbers. And tomorrow they're recording the pretty video. There's the right brain and the left brain. So we've got the left brain for the numbers and the right brain for everything pretty, if I got those right. And so that'll be out as well, so you can see both of those. So on those, if you want to get in touch, Jeff and Julian are here. Like I said, we're already almost halfway committed as far as verbal commitments, and it's not official until the subscription agreement is signed and the money's in. So that's when it becomes official. Other than that, then, you know, we can modify that. So talk to Julian and Jeff, and they'll get you hooked up and with investing in that particular deal. So I think that we've done very, very well. I'm very proud of our entire team, our performance, our underwriting, Julian's diligence at making sure that we get really good deals, and our we can't do it without our management team. And in all honesty, getting chills thinking about it, they work their asses off. That is the hardest job in all of real estate investing. It's real easy to make projections on paper. Then they have to go do it. And that's the hard part.
So we have a contract obligation to close February 29th. So we
Ooh,
are
leap
less
year.
than 2 months. Yeah,
All
leap
right.
year.
Thank you so much.
Thank you for
everybody
coming.
Thank you for your
And
trust. I
we'll be
appreciate
here if
it.
you have any questions.